Good morning. It's great to be with you again. February was another almost inconceivable month. Trump's Liberation Day tariffs were completely overhauled and deemed illegal by SCOTUS. And these are tariffs that caused the market to fall 30% when they were announced. Not only that, but we had the US invading Iran again, this time not just with rockets and to destroy facilities, but Trump wants a complete regime change. I mean, these are two huge market-moving events that happened in 1 month. And the month actually ended up, which was rather surprising. We are seeing some weakness today and yesterday. But yeah, I'll talk more about both of those big market-moving events later. For now, let's look at what happened in February. So the big loser for the month in February was Bitcoin, down 13%. This takes the cumulative loss from its peak in October last year down more than 50%, and over $1 trillion of wealth has been lost in Bitcoin. On the other side, the most positive return was from global property. Global property has been dead for quite some time now, but on the back of low interest rates and improved debt liquidity and renewed confidence in commercial real estate, that sector did have a nice bounce for the month. We're still underweight global property. We think there are structural headwinds, but there was a decent bounce. Japan coming in second place for the month, up 6% in rands, and that was on the historic election victory by Sanae Takaichi, and I'll talk more about that with a brief look into Japan this month. Then SA equities coming in third place with 5% return, which is still good. And then emerging markets slightly behind that in fourth place. And both South African equities and emerging market doing well on the back of a weak dollar and strong commodity prices, not just gold, but all round. Of course, now we're seeing the oil price rallying, which should be a headwind to South Africa and quite a few emerging markets. A lot of emerging markets import oil, and oil is up 33%. So we'll have a look at those impacts when we get to Iran. Otherwise, on the negative side, FANG down 7% and China down 6%. That's mostly on the back of the software services companies being targeted. And we'll talk more about that, particularly on a FANG update slide and the impact there of the AI on software service companies. So some big moves overall. World equities flat, with SA equities doing very, very nicely, up 5% for the month. And this translated pretty much as expected through to the funds. We can see the Sygnia Global Property ETF up 8% for the month. Very nice return there. Japan up 7%, emerging markets up 6%, and then two South African funds in the top 5, the Divi and the top 40 ETF. Over 12 months, it's still very much a South African story, very much an EM story, and South Africa benefiting as part of EM. So top 40 in 1 and 2, SA property in third place, Divi in fifth, and EMs in fourth place. So South Africa being hurt generally for the month in terms of sector exposure. So our industrials were down on the back of Naspers and Process because China was down on the back of their big software companies, Alibaba, Baidu, and Tencent. It's all part of the FANG story. Meanwhile, EMs as a whole were supported by Taiwan and South Korea, which have more AI enablers. So let's have a look at just that big story.
In just the last 4 months, the use of Claude and Claude Code has doubled.
That is just incredible. So Claude and Claude Code usage doubling over the last 4 months. This is a man I'm sure we're going to hear a lot more of as Anthropic takes the world by storm and certainly takes the business world by storm. Anthropic currently has 60% market share or enterprise market share. So certainly the leading number 1 AI used by businesses. And Dario Amodei is becoming more and more prevalent in terms of that great success. And certainly the release of Anthropic products had a huge impact on software companies this month. So Anthropic released a productivity tool which targeted in-house legal departments and HR departments, and that led to $300 billion being lost in the publicly traded software companies. And we're talking big names like Salesforce, ServiceNow, and even Adobe, which we all know. And then a week later, Anthropic released security software, an AI tool for hunting software bugs, and this had a similar impact on security software companies. So big falls in software companies for the month. And you can see it in the chart here in blue, software and services positioning -3 standard deviations away from the norm. And that's so these are the software adopters, and these are companies now that use AI, such as Palantir and CrowdStrike, but are at risk of being replaced by AI at the same time. So the risk here is that AI agents can accomplish the tasks that these software companies are currently selling, or if they can't accomplish the tasks on their own, that AI makes coding accessible to the extent that companies can launch their own software in-house to take on the large software companies. And we saw this happen this month. Walmart released its results and it rallied on the announcement that it will build in-house software to allow online shopping. So we had this huge switch over the last decade away from brick and mortar to online sales, particularly retail sales, including food, which has hurt Walmart and other bricks and mortar companies. And now, within the space of a month, a huge swing back as everyone thinks that all of a sudden using AI, companies can just build their software overnight and take on those big companies. Now, as a very big user of Claude and AI, I can understand the concern, but it's not as simple as building that software overnight. Vibe coding does have a few constraints around it, but that's definitely what the market is concerned about long term. And it does make some sense to some extent because the software as a services companies, they peaked during COVID. It was obviously, you can imagine, there was this huge demand as we were all locked down and had to move online. Zoom and other companies saw their prices increase tenfold. And since then, so since the 2021 peak, as the sector as a whole has seen declining sales every quarter over the last 5 years. So there was already some anxiety around these companies as life became more open, and we kind of, yes, we're still using Teams and Zoom, but also travel, and there's more of a balance. And as that huge unnatural COVID spike normalized, those growth rates are coming off. And now on top of that, there's this AI risk. Meanwhile, the green line shows semiconductors, and that you can see is at a 4 standard deviation event in terms of positioning. I mean, that's just huge. And this is the bricks, the picks and shovels, as they say. You know, if you were instead of buying gold companies, you should buy the companies that are supplying the gold miners with the picks and shovels. So when it comes to semiconductors, that's Nvidia and Broadcom, and they're supplying those semiconductors into the AI companies. And demand there is, again, unprecedented. I mean, these companies just can't meet the current demand. So supply is coming online, and these things will change. But for now, there's just huge demand for semiconductors. Not only Nvidia and Broadcom, which are within the FANG fund, but globally we're seeing it. South Korea, as I mentioned, and Taiwan, both heavily weighted towards their respective semiconductor chip manufacturers and memory manufacturers, and those companies have gone up 4-5-fold over the last 6 months on this huge demand. So that's kept EMs well bid, and these companies. But as I said, FANG had a tough month, and it's had a tough probably 6 months. So it's not just the software companies which have re-rated. And certainly the software companies now are back at the valuations they were pre-COVID. So we're just seeing a normalization of the software company valuations and removing that COVID spike. But the hyperscalers have also seen a derating. So we're talking about the big platform companies, Amazon, Microsoft, Meta, Google. Their share prices have been under pressure, because their concern is that the huge amount of capex they're spending, we're talking $600 billion in 2026 alone, that they're not going to be able to monetize that. They're not going to be able to get the return on capital that they're making. And while this is definitely a concern for a couple of companies, I think the big four are relatively safe. Not only are they using current cash flows for the capex, but they also are generating AI revenues through their cloud services. So we're still confident that those companies have good upside, and the re-rating is just giving you a better entry point into the sector. Now, AI is not just large language models. We're moving forward. We're expanding into physical AI, and I'm not just talking about Elon Musk's dancing robots. And also, we've seen the recent China parade. That their robotics are also phenomenal. But Amazon's warehouse automation is just unbelievable. Amazon alone has over 1 million robots. That's more robots than any other country in the world as a whole country besides China. Google's Waymo autonomous vehicle platform is also moving in this direction. Apple's also focusing on products. They're looking at wearables, glasses, pendants, and AirPods with AI capabilities. So moving into the physical side of AI and the consumer side of that as well as robotics. Meanwhile, the Netflix share price has been under huge pressure. There was a concern that they would overpay for their Warner Brothers bid. Definitely, I mean, they were paying nearly 10 times what that company was valued 2 years ago, but they have stepped away. And since that, the Netflix share price has recovered. So overall, we've seen for a variety of different reasons, the FANG.AI shares being under pressure besides NVIDIA and Broadcom, and generally offering a much better entry point. And it's not just that they're offering a good entry point, but there's some structural changes which will benefit the FANG stock. So as an entity, AI is labor displacing. Now we all know about this. The concerns that we will see, or as labor in the US has been stagnant for some time. I'll talk about it in the US, but we are seeing a small recovery. But generally, AI will replace some people. And that goes straight to the bottom line. So while it's labor replacing, it's also margin enhancing. So this is good for companies, provided obviously that you don't go into a Great Depression because everyone gets laid off. But it doesn't look like that's happening or likely to happen anytime soon. So there's the natural margin enhancing basis of the FANG companies. Plus, governments are focusing very much on sovereign AI. The US wants their AI companies to dominate the world. China wants their AI companies to dominate the world. So suddenly antitrust has gone out the window, and governments want their large tech companies to really gain global market share, even if it's at the expense of employment or even healthy competition. And that should help these companies go from strength to strength. So a lot of good reasons why now is the good entry point for FANG. We are very tempted to in fact, specifically over the last 2 days, to start topping up our FANG exposure as the markets pull back. But for the moment, we are overweight emerging markets, and that gives us a lot of tech exposure, particularly through South Korea and Taiwan, in terms of the AI enablers. So we overweight AI enablers through our emerging market overweight. It's giving us a lot of tech overweight as well. So we don't want to take on any additional tech for now, but we may start to switch some of that EM into FANG to broaden or at least diversify away from enablers into adopters as well as the hyperscalers and take on some FANG exposure. We still think that these are amazing global companies with huge moats that really will be around for a long time. Great. So that's the view on FANG. Positive, but not buying just yet.
Other alternatives will now be used to replace the ones that the court incorrectly rejected.
Okay, so I mentioned there were two huge market-moving events. Well, actually, ironically, two huge events which should have moved markets but didn't really. And the first was the Trump tariffs. So the US Supreme Court, or SCOTUS, ruled that President Trump's, or POTUS, reciprocal tariffs were unlawful, and there was a knee-jerk reaction where the dollar weakened slightly and US bonds weakened slightly. And then within a couple of hours, that all normalized and the market just looked through it. Now, and that does make sense to some extent because the 10% tariffs that Trump announced, and he's looking to try and push that to 15%, should bring in roughly the same amount of tariff revenue, which should keep the US budget deficit in line with what it was. So there shouldn't be any reason for bonds to weaken and hence the dollar to weaken. So from that extent, you can understand that movement. But it does create a lot of uncertainty. Firstly, there's the refunds. And the number is, I've heard different sources, but somewhere between $200 and $300 billion possibly needed to be refunded. It doesn't look like it when you read the SCOTUS statement. They didn't really call the tariffs illegal. They just said the way the tariffs were applied was illegal. So I don't think there'll be a refund, but that is one uncertainty. The other is the uncertainty that it does to trade. So suddenly you've got companies that have spent the last year, reorganizing the supply chains and going from China to Taiwan to Korea to South Africa to wherever to try and get, cheap entry into the US. That's all gone away. Trump certainly can, on top of the flat global tariffs, he can do sector-specific tariffs like autos. So we might see more of that, and copper and other specific tariffs will probably come in to bring that back up to 15% or higher than 15%. So, there will be rebalancing. But the question is, for companies, what do they do? Do they stick with their current plan? Do they rebalance? It just leads to a whole lot of uncertainty. Now, at the same time, this has limited or constrained Trump's power. So even though there's uncertainty as to how companies are going to manage the new tariffs, the world can take some comfort in that the Liberation Day tariffs can't happen again, that they have been deemed illegal and Trump won't be able to. Not only that, but we have got the US midterm elections coming up quite soon. And so, it's unlikely that Trump's going to make too much noise about this because he's worried about domestic inflation, and inflation is looking a bit scary in the US. So overall, quite surprising that market didn't react sell off due to the uncertainty, but maybe they are comforted by the fact that Trump is constrained to some extent, and we have overall certainty on tariffs. But definitely something that we think has raised global risk, and we're going to be keeping an eye on this. But looking at the fundamentals of the US, we remain neutral US and Europe and Japan, although we still overweight emerging markets. But the US looks fundamentally very strong. Atlanta Fed's GDP now projects 1Q, so current quarter GDP above 4%. That's nearly double trend growth. More importantly, employment, which has been the big concern for the Fed, and that's what allowed the Fed to do the 3 risk cuts at the end of last year. So they cut interest rates by 0.75% over the last 6 months of 2025 because they were worried about employment. But the non-farm payrolls that came in was double what was expected. Not only that, the unemployment rate fell more than expected. And if you look at the charts on the right, in blue, you can see small business net hiring plans for the next 3 months. That's picked up very nicely, close to 20% growth. And that leads non-farm payrolls quite nicely. So we've got strong growth, we've got stabilizing and improving employment. So it's not surprising that inflation has come in higher than expected, as we've been concerned about. So US core PCE index rose to 3%. Now remember, the Fed targets 2%. We're now a whole year down the tariff line. We're 5 years down from COVID, and the US inflation has been around 3% for the last 5 years, which cumulatively is very, very, very high relative to the Fed's 2% target. So with high growth, stable employment, and persistent inflation, it's unlikely the Fed's going to be able to cut in the next 6 months. Now, people are concerned about Kevin Warsh being appointed to the Fed. He only comes in when Powell steps down as chair in May, but it is expected that Warsh will be a dove. That said, the fight for Fed independence is not over. So already we have Fed Governor Michael Barr, San Francisco Fed President Mary Daly, and Philip Jefferson all coming out to say that, hold on, not only is growth strong and inflation is sticky, but we think AI could raise the natural growth rate or the potential growth rate of America, which would mean that interest rates would have to be higher. And so we shouldn't be cutting. So already that debate has entered into it. So, although there may be some doves coming into the Fed is fighting back before those doves even enter. And that generally should be good for the dollar and overall for the US. So fundamentally, the US remains sound. Fed independence remains in place. And I think once we see a reduction in global uncertainty, and certainly what's happening in Iran is not helping, but we could see some outperformance of the US. But we're not there yet, so we remain neutral.
Japan's Prime Minister.
She is pretty cool. She's a mold breaker. Of course, she's the first Japanese female Prime Minister. She is not a part of the old party machinery in the sense that she comes from a very ordinary middle-class background, whereas many of Japan's former Prime Ministers have been the sons of former Prime Ministers or former ministers. She is a sort of refreshing character. She communicates well on social media. She plays the drums.
Cool, refreshing, and plays the drums. So certainly an extraordinary person. We haven't had a segment on Japan for quite some time, but this really is market-moving news. So Prime Minister Sanae Takaichi's Liberal Democratic Party won by the largest election margins since World War II. Just a stunning victory, not just the largest victory, but a completely revolutionary person coming into the prime minister's role. As a result, the Nikkei surged over 5% on the day to record highs, and markets are now positioning for the Takaichi trade. So what does this mean? Well, it led to quite a big wobble in Japanese bonds, and the yen weakened quite considerably because the concern is that with the very strong fiscal support that Takaichi is talking about, she's trying to get the employment to grow faster, she's trying to get the economy to grow faster, that could lead to inflation, and that could lead to the fiscal dominance, which is a concern we've had about the US, and as a result, the yen also weakened. But we don't think that we're heading for another lettuce Liz movement like happened in the UK for a lot of reasons. So first of all, let's talk about inflation in Japan. Inflation is now cooling. Real wages are rising at about 0.6%, which is in line with productivity growth. So overall, unit labor costs are moving sideways. So that's a good point. Inflation really isn't too much of a problem for Japanese competitiveness. Similarly, interest rate differentials between Japan and the US continue to narrow. So Japan's raising rates while the rest of the world is cutting rates. That will support the yen against the euro and the pound and the dollar. And as the currency, the yen appreciates, it'll further take pressure off inflation. But I think the big thing to focus on is debt. Now, yes, Japan does have the largest debt to GDP in the world. Well, at least in developed markets, sitting at 237%. I mean, it's massive. It's more than double the US and the EU. So certainly something to keep an eye on. But what's very important is the savings culture of Japan, the government and of the private sector. So Japan just doesn't have debt. It's also got huge amounts of assets. So once you strip out the assets, the foreign assets that it owns, that debt to GDP falls to 134%. Now, in line with the US and Europe. And once you include its local holdings of its local bonds, so it's got a lot of primarily local debt. So it's not like it relies on foreign debt like the US does. It's got primarily local debt. Once you include the fact that it owns local assets, that drops to just 47%. And that's incredibly low from a debt to GDP perspective, or amongst the lowest in developed markets. Not only is Japan's debt completely manageable, but it runs a very, very large current account surplus. China, Germany, and Japan run the three largest current account surpluses in the world, and that's all basically exports to the US. The US runs the world's largest global deficit, about $1 trillion. All funded from Japan, Germany, and China. So it's understandable that Trump wants to try and turn that around, although so far he's not really winning. But the important part of that is, with this huge current account surplus, all the exports, the Japan's private sector generates enough savings to fund the fiscal deficit with huge room to spare. So again, there's nothing to be concerned about from Japan's debt, and I think that the new Prime Minister should be able to support growth and without seeing too much concern in the bond market or the currency market. But for now, we remain neutral Japan, as we do Europe and the US.
From 1st of May onwards, China will impose no tariffs on imports from 53 African countries. This was announced by Chinese leader Xi Jinping on Saturday, according to reports from Chinese state media.
So what can be said about tariffs? I think China is very quietly getting things done. There's a lot of noise coming out of the US. Tariffs go up, tariffs go down. Meanwhile, China is just getting on with business and taking market share from the rest of the world and doing incredibly well. So here we have Xi Jinping's announcement of an extension or expansion of the Belt and Road Initiative, including 53 African nations, including South Africa. So all of a sudden, we have 0% tariffs to China. So our exporters who were sitting with 40% tariffs to the US, now down to 10 to 15, do they take the risk of moving back to the US? Those tariffs could go up, or do they start looking for new exports into China with 0% tariffs? So, I kind of know what I would do. So, China just getting things done. And that's shown by this chart on the right, I think, quite clearly. So if you look at the bottom in purple, this is China's international investment position. So everyone focuses on official forex reserves. China's forex reserves have not increased over the last, 15 years. That they've been sitting at $3 trillion. So yes, the amount of gold sitting in China's FX reserves has increased slightly, but it is dwarfed by the huge increase in the rest of their international investment positions, which are now close on $12 trillion. So what have they done? Well, China's focused on this Belt and Road Initiative. Private firms have expanded production offshore to have resilient supply chains. Policy banks and state entities have stepped up overseas lending and investment. And you can see their portfolio investment, direct investment, and other investment has all gone up. So while the rest of the world is fretting about what to do in terms of the FX reserves and how much gold to have or Bitcoin, China has dwarfed that completely by investing into roads and infrastructure, harbors, airports, railways across Africa, Europe, and other countries to just get a foothold into exports and ensure that it can continue to grow. So very much an expansionary mindset, an economic mindset, compared to the US's very much insular mindset and focusing on only on making itself great again internally, except for the odd war now, which seems to come at some sort of, I'm not quite sure how that is explained by making America great again. But anyway, we'll get to that war. Not only has China expanded into the rest of the world, but it's funded it a lot by selling down US treasuries, or at least letting them mature without buying more. China, at its peak in the early 2010s, had 14% of US treasuries. It's now down to only 2% of US treasuries. So it really, it's almost meaningless in China's life, and it definitely reduces the amount of threat that the US can hold over China. But also at the same time, it reduces the amount of volatility that China can impose on US treasuries by quickly trying to sell those down. Now, as I said, China this month was hurt quite well. I suppose toward the end of February, but also in the last few days, it's been hurt quite hard as software services get sold down, and that's impacted its companies. So, for example, Naspers and Process, which own Tencent is primarily a gaming business, and suddenly AI can recreate those games and sell them and take away market share. Now, while you can debate the ability of AI to do that, it's much harder to replace that moat and that client base that any of these companies have. And I think that the market is certainly overdoing what has happened.
We are restructuring ESCOM and establishing a fully independent state-owned transmission entity, as I have said before.
So a lot to talk about on South Africa today. We had SONA and we had the budget. I hosted an interview with Professor Haroon Borak yesterday on the budget. So please have a look out for that, those snippets. Really, really interesting budget. It's probably the most intriguing budget, brave budget, good budget we've had in 15 years. So I'm going to explain exactly why. But at the same time, although the budget was fantastic, we're still underwater. Yes, we're trying to get to the surface, but we're in trouble, and I'll also explain why. But it's good that at SONA that President Ramaphosa was focusing on fixing Eskom. Eskom has announced that its municipal debt, so that's what municipalities in South Africa owed Eskom, has risen again over the last quarter to 111 billion rand, and that's just huge. And 63% of municipalities are in financial distress. These are big, big problems. It's not just the SOEs which need to be fixed, and certainly I think the SOEs are turning a corner, but now focus has to be on the municipalities, and that's exactly what we're seeing. So Operation Vulindlela is phase 2, and it's focusing on municipal reforms. Some of the good news that was announced at the budget, National Treasury has announced a 30 billion rand performance-linked reforms for municipalities, so that it only releases that once the municipalities have reached certain goals. And new legislation has allowed Eskom to sell directly to consumers and bypass municipalities to avoid this debt issue. And legislation is in the works for this to apply to water as well. So that doesn't really help municipalities. It just means they're going to have even less money, and they're just going to collapse. So certainly a lot of focus needs to happen there. And as a whole, reforms are needed and growth is needed. But let's get to the details. So the budget was better than expected. Or let me not say that. The budget was in line with expectations, which were better than what happened or forecast at the medium-term budget policy statement last year because of the commodity windfall. So we were all expecting it to be better because of the commodity windfall, and it was better. Unfortunately, further out, the forecasts have weakened due to weaker personal income tax and weaker VAT collections. Now, if you look at the chart on the right, you can see that we had in this calendar year, we're expecting about 30 billion rand extra in tax revenues from the platinum companies and gold companies, from tax royalties, from taxes and royalties, and that's supposed to be even bigger in the next financial year. So there is this revenue windfall, which has helped and should help towards the end of the year, and that is definitely an upside risk to the budget. But there are also some downside risks to the budget in terms of wage bills, social grants. I mean, the COVID grant is still only in the budget for 2027, and suddenly you've got to find an extra 30 billion rand a year thereafter. Okay, but let's look at some of the details. So once again, the debt to GDP, which is forecast to peak this year, which is a good thing, was revised higher again, a full percent higher, from 77.9% to 78.9%. Not only that, but the budget deficit is forecast to increase next year from 3.8% to 4%. So while debt is consolidating next year and the following year, it's only consolidating because we're selling the family jewels. 76 billion rand is being drawn down from GFECRA over the next 2 years. So why, when you've got this commodity windfall, are things getting worse? Why do we need to sell the family jewels to get debt to consolidate when we've got this windfall? Well, the problem is very, very much this. And Haroon pointed this out in Signals yesterday and in the interview. If you had to think of South Africa as a company, we are currently cash flow negative. We are not covering our own expenses. So ignore debt, and we've got a huge amount of debt. If you just look at what we're doing, tax revenue in on an annual basis and expenses. So that's expenses like interest, wages, transfers, and your current expenses. That runs at a loss. So it makes sense then that debt to GDP is rising next year, and we have to cover our operating expenses, let alone trying to invest for the future or paying down debt. And even on the current forecasts, debt to GDP, even looking out all the way to as far out as the budget looks, which is 2033, debt to GDP is only going to fall to 68%, whereas EM's, the sustainable debt level, is 60%. So we're definitely underwater. We're definitely still in trouble. I think our bond markets are pricing in way too much good news. And that's why we are neutral SA bonds. And the only reason we haven't gone underweight SA bonds is because of the positive emerging market story and the weaker dollar story. So very much a global story is keeping us neutral, SA bonds, and locally we think there's way too much good news priced. So we need growth to improve. Now, growth is not forecast to rise rapidly. Over the last decade, growth has been sitting at about 1.5% or 1% to 1.5%. So it's abysmal. We're not creating jobs. We're not growing fast enough to pay down our debt or to climb our way out of this debt spiral that we're stuck in. So things are not good. We're still in a tough space, and I need to stress that. But the budget was very, very, very brave, and it actually very, very expansionary in terms of not only is there R1 trillion that's been over the next 3 years that's been put towards infrastructure, which is good. But, again, we've had lots of promises over the last 50. In a long time, we've seen some positive tax changes, and that should lead the private sector to start investing for growth or hiring more people. But suddenly, small SMEs, small medium enterprises, and individuals are going to have a huge tax break over the next year. Huge changes at the SME level and at the individual level, and that hopefully will see the private sector driving growth going forward. So it's a change in mindset with the government saying we haven't been able to get growth corrected. So let's try and help the private sector by reducing taxes to grow. And this is desperately needed because, as I've said before, in terms of the Laffer curve, which is how much personal income tax you can put onto individuals, we're way past that curve. The incremental taxes or the increases in tax rates over the last 2 years without any bracket creep adjustments have led to less money being raised by SARS, not more. So clearly pointing out that we're on the falling side of that Laffer curve. So let's look at some of that tax relief. Firstly, for the first time in 2 years, personal income brackets have been shifted. So that means that we'll all get more take-home pay, and that's desperately needed because PIT is actually the biggest source of revenue for our government, and 7.7% of all taxpayers make up more than half of that PIT. So a very narrow tax base, which actually shrunk. But some good things which should get people to start focusing on growth and being less reluctant to pay tax. We've seen big inflation adjustments. So retirement annuity caps, so this is important for savers, raised from 350,000 Rand to 450,000 Rand. The increase in tax-free savings accounts from 36,000 Rand to 46,000 Rand a year. The CGT exemption raised from 40 to 50,000. Primary residence, so used to have the first 2 million Rand was tax-free on selling a primary residence. That's been raised to 3 million, so a 50% increase on that. Your travel allowance, which is taking money offshore, we raised from 1 million to 2 million Rand, so that's been doubled. And as I said, a whole host of tax relief for small, medium enterprises, which should see some on-the-ground growth within South Africa. So for the first time, I'm quite excited that the government we don't have to rely on the government to try and get our growth to recover, but we might see particularly small, medium enterprises leading that growth as a result of some tax relief. So that is very good news. Plus, that there was quite conservative allocations of the windfall from commodities in the budget. So I think there will be a little bit of a surplus coming through by the end of the year, although very hard to tell. It all depends on exactly what happens to commodity prices going forward. So we remain overweight South African equities, but that's very much, again, a global story and a gold story in particular, a precious metal story on the back of weaker dollar and global uncertainty. If we see that global uncertainty start to fall off, we will either reduce our SA equities or switch into the Transnational Fund, and I'll talk about that, the Transnational Fund, after positioning.
The United States military is undertaking a massive and ongoing operation to prevent this very wicked, radical dictatorship from threatening America and our core national security interests.
Sure. So we have effectively a war going on in the Middle East. Not only has the US sent rockets into Iran, but Trump is talking about potentially putting troops on the ground and a regime change, which ideally for everybody will be quick, but could be quite prolonged and is definitely creating a lot of uncertainty. So Operation Epic Fury, I'm not making it up, that is the official code name for what's happening. Epic Fury saw the US and Israel launch coordinated missile strikes against Iran, which killed their supreme leader. And Iran responded by not only retaliating against Israel, but across the entire Gulf. So that has seen the rest of the Gulf supporting the US and condemning Iran, which is very much isolated Iran, which means this is not likely to escalate, which is a good thing. And as a result, we've seen OPEC Plus come out to say that they are going to increase oil supply as much as possible to offset any supply disruptions because of Iran not supplying oil, or any pipelines which get hit by missiles, or the Straits of Hormuz being closed. And all of that leads to increased risk. And the oil price, as I said, is up to $80 a barrel, which from the start of the year is a 32% increase. But it hasn't gone up nearly as much as natural gas, because of the fact OPEC Plus is going to increase supply. UK natural gas peaked on yesterday, 55% up. It has recovered slightly, but a far bigger impact on natural gas. So what does this mean for the world going forward? Well, certainly oil is likely to stay at these levels while there's uncertainty, so around $80 a barrel. Trump said that this could last a few weeks. No one quite knows exactly how long it's going to last. It all depends on how Iran responds. But if it remains at these levels, if oil remains at these levels, the $80 a barrel for the next 6 months, well, that decreases growth by 0.6% and increases global inflation by 1%. Those are huge, huge impacts. All of a sudden, central banks in emerging markets, which have been cutting, have to hike. The US could be forced to hike and not cut, and that would disrupt the equity market completely. So we could see a lot of volatility coming through. Now, on the one hand, we don't know how long it's going to last. And Trump is definitely playing hardball, but that's his negotiating tactics, so that's not a surprise. As I said before, when it came to the tariffs, we do have midterm elections. Now, the Democrats are really making a huge story about this invasion and a huge story about the tariffs. So there's a lot of pressure. So a lot of it depends on those midterm elections. The betting polls are sitting at an 86% chance that Trump loses the House in the elections, which would lead to a split Congress, which again would reduce Trump's power. So suddenly SCOTUS has ruled the tariffs illegal, and now Trump loses the Republicans lose the House. All of a sudden, from November, you're going to have a lot less Trump impact. It does still allow him to worry about foreign policy, so he might focus that foreign policy globally, like he has with Venezuela and Greenland and now Iran. So we might see more of that, and that can be quite volatile all on its own. But given what we saw in Venezuela and Greenland, it's definitely not in Trump's interests for this to go on for too long. So it's while he is negotiating from a good place of strength, and we've got the strongest, largest US carrier group in the Gulf since 2003. Since Iraq, It does depend on Iran, so we're not quite sure how long this is going to last, but the estimates are a couple of weeks, not a couple of months. So we'll have to see exactly what that means. But certainly, the longer it lasts, the bigger impact it has on the market, and the more likely that we will downgrade our equity exposure from overweight to neutral or even underweight. At the same time, South African equities benefits from gold, so we might keep our overweight in South African equities. But a huge impact, the major impact here is through inflation from the natural gas prices and the oil prices. Natural gas obviously impacting Europe more than the US. But for now, so ignoring what's happening in Iran, which started on Saturday, so very much a March issue, and we are debating that on an ongoing basis. For now, we stay overweight equities and overweight emerging markets and overweight South Africa because growth remains above trend. As you saw, the very strong growth in the US, very strong growth in China. The EU is stepping up its defense spend, so it's also seeing some strong growth. Overall, what we're seeing is a broadening of growth in the world away from AI to non-AI as other companies now adopt AI and use it for them to grow. So we're again moving from the enablers to the adoption. We haven't seen that in earnings numbers yet or even share prices, but that's what should lead growth over the next 12 months. But importantly, if you look at the charts on the right there, we've also got easy financial conditions. So interest rates have fallen, but it's not just interest rates that have fallen. Credit spreads have narrowed, equity markets are up, and that all leads to a more stimulative economy and a more stimulative backdrop for consumers, and consumers who have slowed down over the last month or two are likely to continue to spend. So, we're concerned about Iran, a little bit concerned about tariffs, quite concerned about valuations because valuations are looking quite stretched, not concerned about growth just yet. One of the reasons we aren't going overweight EU, despite the defense spending, is that the EU still has structural weaknesses, overregulation, fragmented capital markets, rigid labor markets, and those aren't going away. We're not going overweight the US just yet, partly because we're waiting for some stability in the software companies, but also because of tariff uncertainty and midterm elections, which could lead to some news coming out. And as a result, we keep up our positioning in emerging markets, driven mostly by China because of the quiet, steady way that they are handling the tariff war and winning that, even though performance in EMs is being driven by the semiconductor stocks. So weaker dollar, semiconductors, China resilience, and gold keeping our positioning really unchanged for the last 10 months. But some big volatility happening yesterday and today. Not so much yesterday, but today we're seeing some big risks off, and we'll be monitoring that to see if stop losses get breached and if views get changed in terms of higher inflation, fewer interest rate cuts, lower growth, and what that means for our positioning. So we are watching that on an ongoing basis. Before I disappear, quick look at the Transnational Fund. Now, this was raised to me by one of our clients, and I thought it was quite amazing that we looked at the top 14 holdings. So, this was picked quite specifically, but if you look at the top 14 holdings of the top 40, so it's the all-share top 40 index, it's really, our top 40 index is a three-legged dog. It has only three legs. Precious metals, which make up a third, that's gold and silver. Banks, which make up a fifth, China tech, which makes up a 10th, and then there's this, it's got a limp fourth leg, which is MTN at 4%. But you really are taking very, very strong views if you invested in the JSE index because of our very big weights to precious metals and banks. The Transnational Fund, on the other hand, it's focused very much on global stocks. So if you're expecting a recovery in South Africa, it's not what you want. But if you want global exposure through South Africa, you can see there, instead of 33% to precious metals, it's only got 15%, so less than half. It's also got diversified minerals, so BHP, which gives you nice exposure to oil. So that's quite defensive in the current market. Glencore, which is exposure to copper, which is a structural tailwind due to all the growth in China and EVs and things. And then other global stocks are 10% to British American Tobacco, which is tobacco, obviously, 10% to Anheuser-Busch, which is brewery stocks, 10% to jewelry through Richemont, 10% to Chinese tech through Naspers and Process, 7% to MTN, which is Africa Telcos, and then some other exposure. So just a nice way to diversify your portfolio. So maybe you have a blend of the two, or if you want to take a strong view on gold and platinum, you only hold the top 40, or if you want to take a view away from gold and platinum, you only hold transnational. And then just to remind you that this fund has got a zero fee class. There's a zero fee class that only has performance fees. So you'll only pay fees if this fund beats the all share index, which is its underlying benchmark. So win-win. You invest in it. If you don't make the right call and it underperforms the all share, well, you don't pay any fees. If it does, well, you pay a performance fee, but you're still winning relative to the other fund. So I think a great diversifier for those worried about the gold rally. Okay, that's it for today. Let's move on to Q&A. Wayne Gfekra is our Forex dollar and gold holding. So it's basically selling the gold that we hold, hence family jewels, and using that to pay down debt. Anonymous asks why the FANG.AI Fund has performed poorly since November. I hope I've explained that. The FANG Fund has a nice broad exposure against the hyperscalers, the enablers, and the adopters. And while the enablers have worked quite well, the adopters have performed poorly as services have sold off, and the hyperscalers sold off on the concerns that they're spending too much capex on AI. But we don't think the growth story has changed at all. We think it's a better entry point. Just we're not getting involved just yet, while we have a lot of tech exposure through emerging markets. Rabindranath, apologies if I'm pronouncing it incorrectly. Can you buy transnational stockbroker? The Transnational Fund is only a unit trust. It's not available as an ETF. So you'll have to buy it on our platform. John says, has Naspers fallen more than expected? Good time to get in. John, Naspers has been hammered with the same thing that's impacted Adobe, ServiceNow, CrowdStrike, all of the software companies globally. Naspers is an online software business process as well. It's got a lot of online food retailers. So Tencent has been hurt. Processes other online companies have been hurt, all because the view is that AI will replace these software companies. Whereas I think AI will probably just allow these companies to entrench their moat, because it's not just the bricks and mortar companies that can suddenly start using AI, but so the software companies can also start using AI. So the race, everyone's got the same tools, and I think the race will continue as it has going forward. Okay, that's it for questions for today. Only those 5 questions. So, sorry, there's you just come in. Tammy, do you expect Bitcoin to appreciate in the next few months? Tammy, Bitcoin's very much a momentum-driven entity from what I can see. So right now, momentum is negative, so people are selling. It might take quite a while for it to form a new base once its moving averages catch up to the price, and then people can start building a base and then see it recover. So I would be surprised if Bitcoin appreciates in the next few months while it's forming a base. What are we expecting from venture capital OSC in next year? This is a question from Peter. So we actually have got some very positive news coming up at OSC. So we had the unicorn, which was IonQ, that pushed the valuation quite nicely upwards. There's also some more good news that was announced at the latest results session. I can't remember the names of the exact companies, but they've sold one or two more other smaller businesses, and there's a potential for the unicorn, even though it's been sold on. It's got to meet certain milestones. So if it meets those milestones over the next year or two, we'll have a second unicorn, which should create a good path for OSE to rise from 160 to $2, so £2. So some nice upside, or quite a clear path to get to £2 on that OSE share price if that second unicorn meets its milestones. But overall, we've seen some very good news coming out of the companies within that. Johan says your gold outlook for the rest of 2026. Johan, you shouldn't ask me about commodities, particularly gold, because I have got gold so wrong, and I'll probably continue to get it wrong. I think gold has hit a double top, and I think gold is going to come off. We might have to see the Iran war come to an end before that happens, but I think that there's too much uncertainty is priced into the gold price. Yes, emerging market central banks will continue to buy gold, but if you look at China, for example, it's far more lucrative for them to invest strategically around the rest of the world than just buying gold. It makes their money work for them as opposed to a zero income asset. So, yeah, I'm negative on gold, but I'm aware that the trend is upwards, and that's why we're staying overweight South Africa. I'm definitely not shorting gold just yet. The trend is still upwards, but I do think at some point that trend will break down and gold will see a retreat in its price. Wayne says commodities to rally further. Are there further indications that will continue? So Wayne, if you have to look at fundamentals, China's still good, which should support copper, for example. It all depends on what happens in the US. It all depends on what happens with interest rates. If the oil price stays elevated, then that headwind to growth is going to cause the rest of the commodity basket to come off. So it's very much right now dependent on the Iran story. George says, how do you see SA property going forward? George, we do have a small exposure to SA property on the back of falling interest rates in South Africa. That has worked very nicely for us, as we've seen SA property gone from deep value to probably fair value. There's still structural headwinds. And if we start to see the end of the interest rate cut cycle in South Africa because of oil prices, then we'll probably sell SA property. So we're only really holding SA property on this global story of strong rand, lower interest rates, lower inflation, which is supporting SA property stocks, regardless of the structural imbalances within SA. So again, remaining overweight, but it all depends on the interest rate outlook, which depends on oil, which depends on Iran. So very much right now we're at a cusp. George says, how do you see SA bank shares going forward? SA bank shares have had a decent run. For a while, they were lagging the fall in interest rates within South Africa, but they have re-rated somewhat, probably not as much, not to the full extent, but they have done quite nicely. Once again, it now focuses on sort of your global outlook. So are we going to see further interest rate cuts in South Africa on the back of lower inflation and a strong rand, or is that done? Yeah, if we look technically, it looks like the rand has bottomed, and we have seen its lows, and from here it's going to weaken. So you can't really tell because of the uncertainty in Iran. But if you had to just look at what the market's telling you, the market's saying the rand has seen its lows. So in that case, SA bank shares and SA property shares their upside might be capped from these levels. You might want to get involved in the transnational, which has got more upside from a weaker rand. Charlie says the minister briefly referred to the budget allowing local mancos to manage foreign portfolio of assets. And do you see this creating a meaningful opportunity for South African managers, and is Sygnia considering launching foreign donor funds as well as a result? Charlie, certainly. We are very excited if we are able to manage hard currency assets in South Africa. we will definitely open up our hard currency funds, hard currency versions of our funds in South Africa. So, as you know, it's one of the things we haven't done. We've been very eager to open up hard currency versions of our funds, but we've had platform issues. But if we can do that locally, then suddenly that gets fast-tracked, and that would be very, very exciting. So we are waiting for more details, but they are still quite thin on details in that regard. Kugan says, do you have any ETF endowments that is AI related to energy, property, chips, robotics? We only have the FANG.AI ETF. That gives you, as I said, broad exposure to the enablers, the adopters, and the hyperscalers, as well as Apple and Netflix. We don't have any specific AI energy or AI property that is focused on data centers. Now, you saw the global property stocks did rally quite nicely this month. Part of that is that our global property ETF does have a decent exposure to data warehouses. So if you're looking for growth from a data warehouse perspective, then you can look at our property ETF. And you'll see that the sector breakdown does include some decent exposure to AI. But robotics we only have through Amazon and Google within the FANG fund. Fourth Industrial Revolution Fund also has very good exposure to US tech. So the Fourth Industrial Revolution Fund will give you AI exposure, robotic exposure, tech exposure. That's more a medium cap fund, so it's got less exposure to hyperscalers. And more exposure to other companies like which have also done incredibly well, like the other chip manufacturers and other AI companies. Anonymous, I would assume that the 2 million SDA allowance comes into play 1 March or 1 April, but I can't confirm that. Probably 1 March when the new tariffs come into, well, the new taxes come into play. Charlie says China previously sourced a meaningful share of discounted crude from Iran and Venezuela. Yeah, you're certainly right, Charlie, that China and India have benefited from Iran's oil production more than everybody else. A lot of that has been through the shadow market. So India and China have benefited very strongly from oil imports from Iran through the shadow market, and Iran's not being able to export oil will definitely hurt those two countries more than others in terms of oil prices. They'll have to pay more for the oil and get it through traditional channels. So again, it depends on how long the war in Iran lasts. Overall, the world is far less dependent on oil than it used to be. The countries are far more energy diversified, solar, hydro, nuclear. So this spike in the oil price doesn't have as big an impact. I think what you need to watch out for is the spike in the natural gas price, which impacts Europe more than anybody else. So once again, like the war between Russia and Ukraine, Europe stands to lose the most because of natural gas prices. Okay, that is it for the Q&A. Thank you very much, everybody, for joining. It was great to chat to you. Thank you for your questions. March is certainly going to be a very interesting month, so stay tuned, and I'll let you know in April what changes we've made, and we'll hopefully have some more clarity on what's happening on the geopolitical scene. Good luck.